According to the National Credit Regulator of South Africa, there are 20.2 million credit-active consumers in the country, a number that has raised concerns, particularly with the Finance Ministry. The Reserve Bank, too, has raised its concerns about growing household indebtedness. Government now wants to change regulations to limit reckless lending.
They now require that every application for credit be properly assessed in terms of requiring proof of income and ensuring that the expenses that are declared by consumers meet minimum norms.
Under the existing National Credit Act, providers use their own models to grant loans, but it was found that consumers did not truthfully declare their expenses. Government wants more stringent regulations around affordability assessments. If those applying for credit can't afford to make their repayments, they should not be granted any loans.
So we've seen cases where a consumer will disclose that they have no, for example, expenses for food and expenses for transport. Now, we believe as the NCR and as the DTI that credit providers should consider at least food, transport and accommodation when a credit provider is assessing a consumer's application for credit.
The National Credit Act came into law back in 2007. The act was meant to limit reckless lending and protect the consumer, but many found ways around the regulations. To date, millions of South Africans are borrowing more money than they can afford to pay back. And sadly, most of that credit is not being used to generate any other income.
The regulator found that while people are borrowing extensively to live flashier lives, the majority of South Africans are taking out credit just to survive. 76% of South Africans' disposable income is spent on servicing debt.
What we've seen typically is that on average, secured debt like your mortgages and your cars, they tend to perform much better than your unsecured type of credit.
At least 44% of credit-worthy consumers have impaired records. Earlier this month, we saw the fall of African Bank, one of South Africa's biggest micro-lenders, largely as a result of bad debts. There are fears that this will spread to other parts of the banking and retail sectors.
Given what's happened with African Bank, it's highly likely that that would spread, at least to some degree, in that consumers are already battling across the board. So it's a matter of finding out whether retailers and other credit providers are actually making adequate provision for the bad debts that they are experiencing.
Many South Africans failed to take advantage of the low interest rate environment between 2008 and 2013 because of high indebtedness. Now the country is in a rate hiking cycle. The Reserve Bank has lifted rates by 75 basis points so far this year. With more hikes expected, it's going to get tougher. Sumitra, Nydoo, CCTV, Johannesburg.